The stock market has gotten off to a great start in 2023, which is a huge sign of relief for many investors after a very rough 2022. So far this year, the Dow Jones is up 2.5%, the S&P 500 roughly 6%, and the Nasdaq is up over 11% so far in 2023. Many of the growth names, especially the big tech names that were crushed in 2022, have led the charge here in 2023. But at the same time, we've seen value and dividend stocks take a bit of a breather. Are investors starting to feel good about 2023? After all, the markets are climbing. However, the earnings reports and the economic data are starting to show weakening and not painting a very rosy picture. As such, these breathers we're seeing in many dividend stocks and value plays are proving to be a great opportunity for many long-term investors looking to build their passive income. With that being said, in today's video, we're going to take a look at 4 dividend stocks that are actually trading at great valuations that you should buy in the month of February. Let's jump in. Hey everyone, Mark Rushin here. I'm a CPA, and if you have watched my videos before, then you know I love dividend stocks. And I love teaching others about investing and building passive income. In fact, I work with clients every single week to help them learn more, educate them so that they can prepare themselves to meet their financial goals. You can head over to russinfinancial.com to find more information. And before we jump into today's 4 dividend stocks to buy in the month of February, here's a quick word from today's sponsor. Today's video is sponsored by The Motley Fool. The Motley Fool has a ton of great tools and products for investors of all levels. And right now, if you go to fool.com/Mark, you could sign up to receive their top 10 stocks to buy right now. And with that being said, let's get started. Dividend stock number 1 for the month of February is Pfizer, stock ticker PFE. Pfizer has a market cap of $246 billion. Looking at the chart here, you can see in late 2021, the stock reached levels above $60. Today though, the share price is closer to $40, so things have fallen back to regular levels. As many of you know, Pfizer has played a big role and has been a big beneficiary of the pandemic with their vaccine. However, as we said, things have fallen back to normal levels, with shares down 30% from their late 2021 highs and actually down 18% in the past 12 months, with much of that coming over the past 4 weeks alone. Shares of Pfizer are looking quite intriguing. Part of that drop has been related to what has become the downgrade happy analysts of Wall Street. UBS recently downgraded the stock from buy to hold. Why are they doing this after such a big drop off from the shares, you might ask? Their main thesis is centered around a declining pandemic impact. The other area was the fact that their pipeline is weaker in the near term. Well, that is an interesting point because they have a well-documented RSV drug. And if you have heard anything on the news lately, RSV has been running rampant in children this year. But Pfizer has a drug that has received positive phase 3 results showing 81.8% efficacy for severe accounts. If this gets approved, Pfizer's RSV vaccine candidate could be the first maternal vaccine available to help prevent this common and potentially life-threatening respiratory illness in young infants. Regardless, we are now looking at a stock that has a great balance sheet, flush with cash, and continuing to generate strong levels of free cash flow. Those are 2 huge things you want to see in a company, especially moving into slower economic times, aka a recession. The company currently has $1.3 billion of cash on hand and another $34.8 billion of short-term investments that are highly liquid. So we are talking about a total cash position of $35 billion, which alone covers their long-term debt balance of $32.6 billion. Looking here at the cash flow statement, you can see that the company prints money, generating $20.7 billion from operating activities alone the past 9 months, and they spent $2.2 billion over that same time on capital expenditures, meaning they have free cash flow of $18.5 billion. Free cash flow is what is primarily used to pay debt and dividends. Through the first 9 months, Pfizer has paid out $6.7 billion in dividend payments, meaning they have a free cash flow yield of roughly 35%. Speaking of the dividend, Pfizer pays a dividend yield of 3.75% that is well covered, as we just saw. The company has increased the dividend for 13 consecutive years and has a 5-year dividend growth rate of 4%. Pfizer has paid out a dividend every year since 1938. In terms of valuation, Pfizer shares trade at a forward price to earnings multiple of 10.7 times. Over the past 5 years, shares have traded at an average multiple of 13.7 times, suggesting we are undervalued at current levels. Before you run out and buy shares of Pfizer, they are expected to announce earnings on January 31st. So let's take a look at those to get an update from management and see if we get an even better entry price. Dividend stock number 2 happens to be a REIT, and they are Essex Property Trust, stock ticker ESS. Essex Property Trust is an apartment REIT. Now, they're not one of the 2 major apartment REITs, but they sit a tier below, and they happen to be a coastal pure play apartment REIT, unlike the diversification you see from the likes of Avalon Bay. They have properties up and down the West Coast. But as we have seen, the REIT sector has been under heavy pressure these past 12 months as we are going through an increasing rate environment. Over the past 12 months, shares of ESS find themselves down 30%. However, with talks of a Fed pivot coming later this year, now could result in a great time to add shares of this awesome REIT. ESS has properties in Southern California, Northern California, and up in Seattle, Washington. These areas of focus make up the 5th largest GDP in the world. The West Coast has largely been the strongest and most predictable when it comes to a number of things, including a solid job market, higher income jobs, a housing shortage, which all plays nicely into Essex hands. In addition, the weather is also more predictable. The company doesn't just focus on one area. They look at numerous ways to create value, including buying and selling properties, redevelopment with value add, co-investment, or just straight development, and many more. In terms of dividends, Essex pays a dividend of $8.80 per share, which equates to a dividend yield of 3.9%. The company has a 5-year dividend growth rate of nearly 5%, and they have hiked their dividend for 28 consecutive years, making them a dividend aristocrat. Looking here at this fast graphs chart, you can see just how undervalued shares are when compared to their historical average, which is that blue line. Remember, with REITs, we do not look at EPS due to the large depreciation expense that comes with owning real estate. Instead, the better metric is to look at FFO or AFFO. Essex historical adjusted funds from operations multiple has been closer to 22 times. However, right now, shares of ESS trade at a forward AFFO multiple of 16.5 times, well below their historical average, proving to be a great time to add some exposure here for long-term investors. Before we move on to the other 2 stocks, let me tell you about a great promotion going on over at Webull. Right now, if you open up a new Webull account using the link down in the description below and just deposit $100, so just open a new account, deposit $100, they will give you up to 12 free stocks valued up to $30,000. Now let's move to dividend stock number 3, and we are going to continue on with the REIT sector. And we are going to talk about NetStreet, stock ticker NTST. As I mentioned, NetStreet is a REIT. They actually have REIT in their name. But this is a great sector to look for undervalued stocks, given the year that they just saw in this rising rate environment. NetStreet is a lesser known REIT. As we saw, they only have a market cap of $1 billion. The company started in December of 2019 and went public in August of 2020. What a time to go public as the markets were in free fall. Nonetheless, that should not take away from the quality of business that this management team is growing, and it looks and will look very similar to that of Realty Income. They are focused on quality of how they approach the company, and quality on how they take on tenants that they work with. After all, 65% of their tenants are investment grade, with another 14% would be investment grade if they were graded, meaning nearly 80% of their tenants are investment grade potential tenants. That is a very similar blueprint to the popular net lease REIT, Realty Income. NetStreet also focuses on defensive industries, ones that will perform regardless of the economic backdrop. Yet another thing Realty Income also focuses on. You can see the quality of the company's portfolio and their tenants based on their 100% occupancy rate. In addition to having high exposure to investment-grade tenants, NetStreet also has very low lease turnover between now and the year 2025, having only 4.2%, which is incredibly low. Here's a quick look at the company's portfolio and top tenants. They have 8 million square feet of leasable space within their portfolio, all of which is leased, which we saw. The company's top tenants include CVS, Walgreens, Hobby Lobby, 7-Eleven, Dollar General, Advanced Auto Parts, Walmart, Lowe's, Family Dollar, and Best Buy. The only name I would be worried about at all on that list would be Best Buy, which happens to only account for 3.5% of their annual base rent. I will do a future video comparing the likes of Realty Income and NetStreet just so you can see how similar they both are. In terms of the dividend, NetStreet pays an annual dividend of 80 cents per share, which equates to a dividend yield over 4%. The company has paid an increasing dividend for both years that they have been public. NetStreet is going to be a little more difficult to compare in terms of valuation and looking at recent history, since the company's only been public for a little more than 2 years. Right now, shares trade at a forward AFFO valuation of just 16.2 times, and analysts are looking for the company to grow AFFO moving forward roughly 5% per year over the next 3 years. Let's compare that to Realty Income, which trades at a forward multiple of 17.2 times, so a higher multiple, but they are looking to grow just 2 to 3% per year moving forward. I like everything that's going on over at NetStreet. The portfolio that this management team continues to build and the quality looks very similar to that of Realty Income. Let's look at dividend stock number 4, which is PepsiCo, stock ticker PEP. PepsiCo has a market cap of $236 billion, most likely the most widely held stock on our list of 4 today. Looking at the chart on your screen, do you see a trend? Every quarter it looks like the stock has had a nice drop, and we are getting that right now with shares of Pepsi. Over the past year, shares are pretty much dead flat, which is pretty wild, but in 2023, Pepsi shares are down more than 5% already. Not only is Pepsi known as a great defensive or recession play, but they are also an all-around solid dividend play as well. Given the company's dividend hike of 7% in 2022, they are a newly appointed dividend king, making them dividend royalty, as they have now hiked their dividend for 50 consecutive years. In the beverage and snack area, it is dominated by both Coca-Cola and PepsiCo. Coke dominating the beverage sector with Pepsi close behind, but PepsiCo takes things a step further and also has their snack department, something Coke does not really have. The company serves customers in more than 200 countries worldwide, and as you can see here, they have many great brands including Pepsi, Cheetos, Lay's, Gatorade, Quaker Oats, Mountain Dew, Doritos, and many more. The non-alcoholic beverage sector is expected to grow at an annual rate of roughly 5.5% over the next 7 years, and the total addressable market for snacks is roughly $1.5 trillion, growing at a 3% annual clip over that same period. PepsiCo is another company that generates a lot of cash. As you can see here, the company's latest quarter, looking at the balance sheet, you can see they have nearly $7 billion of cash on hand, including short-term investments. And looking at the cash flow statement, the company generated $6.3 billion of cash from operating activities. They spent $2.6 billion on CapEx, which equates to free cash flow of $3.7 billion. Solid free cash flow ensures the company has a safe dividend and also an ability to maintain a growing dividend, as we have seen. In terms of valuation, analysts expect 2023 adjusted EPS of $7.28, which equates to a forward earnings multiple of 23.3 times. Over the past 5 years, shares of Pepsi have traded closer to 26.1 times, meaning now could be a great time to add this amazing company. All 4 of these companies are great companies with strong management team, but they're also continuing to generate strong free cash flow. You're looking for quality and cash flows as you enter a slower economic period, and also a potential recession. But the great thing about all of these companies, even though they're defensive in nature, they're generating strong free cash flows, and they also have solid, well-covered dividends, it's the fact that they're all trading at great valuations. When you can get quality, cash flows, and valuations all put together, that is a perfect time to invest in that company. Down in the comments section below, let me know which of these 4 stocks you believe is the best buy for February 2023. Also, if you haven't done so yet, make sure you hit that like button down below. Subscribe to the channel, as that really helps the growth moving forward, and we'll see you in the next video. Take care.